Hello, 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 everybody. Welcome to the Brink SBDC workshop. I'm going to let everybody come in, but I just wanted to welcome everybody, see some familiar faces, some new faces, so it's all good. I have about I would think like 40-minute workshop trying to get everything kind of packed in there to get you guys till end of year as founders with an investor lens of trying to get you as successful as possible. So um, also, and then like the last 20 minutes, hopefully we'll have some discussion if you want to, or I might be longer. I didn't really practice this one. So um, it's chock full of stuff that it's interesting that as an advisor at the Brink SBDC, I'm able to be boots on the ground, making sure that everybody kind of gets the advice that they need on demand, right? But with that, I have the blessing that I have so many examples of entrepreneurs that are in the trenches right now. So I'm going to give you a historical view of like what typically investors are looking for and what's the timelines of end of year investing and fundraising. And then we'll go into what it is right now a little bit, and then some recommendations and some encouragement at the end. So everybody needs a little bit of encouragement in this entrepreneurial journey. So I know that very well. And so we're going to start right now. I'm going to share my screen and do the presentation. Okay, perfect. So the Brink SBDC workshop is meant to have founders be ready for fundraising, getting in front of investors, making sure that their pre-seed, seed, Series A rounds are as informed as possible so that you understand the process, the tactics, how to do things, but also the why. I'm very much into that because I can teach you all the tips and tricks, but then it's really why is that something that's important for you to understand? Because you don't know what investor comes in the door, and you can really leverage your strengths to be able to conquer most investors somehow, some way. And conquering means that you get that wire or that check, but also they might be great networkers or great resources for you. And we've said in all of these types of workshops, it's about the 3 C's of capital. So financial capital, resource capital, and network capital. So and that would be financial capital is obviously money. Let's go. Money, money, money. Second is resources, meaning that person can bring in business development resources, their own resources, their expertise, all of those wonderful things. And network capital is who they are networked with for co-investments, for syndication, all of that. So within that framework, I'm going to be going through how do you target the right investors before year end? We are right now in October. So we have October, November, December, right? Q4, let's go, right? To make sure that we get these investors interested in your startup. So with that, I'm going to just start going through. Q4 really represents this like critical window. Why I'm kind of giving you that why this matters, because most decisions are made by November 30th. I mean, of course, there is gray area everywhere, but typically, traditionally, what we're looking at is by end of November after Thanksgiving, they have like an understanding of I've gone through all of the due diligence, I've met with everybody that I needed to on my list, and I'm going to wire a check or I'm not going to wire a check or wire money. So really, let's make sure that we know that that's that timeline. Again, there's wishy-washy everywhere. The answer to every single time kind of, well, it depends, right? So, and the thing is that the investor mindset shifts dramatically is that if not now, then you're going to push to 2026. So if you are fundraising right now and your, let's say, deadline is January or February, they will automatically just push you into 2026. Now, the fundraising journey is always a marathon and not a sprint, right? So you can carry on conversations, but no, they are looking at what do I need to decide on by end of year. And if you are a little bit further, they're going to let you go until 2026 or the next year. So you really want to have this, there's this like make or break moment. I just talked to a founder this morning that we were trying to think about, okay, do we do a bridge round before we raise that bigger round? And that bigger round starts in January. That could be a possibility. It could be that you tier it out saying, look, we're going to try to get to $500,000 by end of year, help us get there, because we have some milestones that we need to get to by end of year, and then we'll raise the rest around later. Now you're hearing me that I'm giving him clear time frames, and I'm saying that there's something that needs to be done by end of year. You have to be that like kind of gutsy to say that, and you might feel like, oh, I'm giving them a deadline. Yes, you are. Yes, you are. Right. So that's a little bit of also investors feeling that they're the fear of missing out, the FOMO, when are you really needing this money? Can I delay it? Do I not? And especially right now with the volatility of the market, is that, can I push it out until there's like less volatility or less risk? So they're going to automatically try to push you out, not because you're not a great founder, you're not a great startup. It's just how the environment is now. So you want to kind of decrease that risk, saying, I'm ready now. And I have these wonderful milestones, and I've had the traction to prove to you that I can actually reach those milestones. Isn't that really a great positive way to say, you need to come into my round, because you're going to make a lot of money with me, and we're going to impact the world with this wonderful solution that I have as a startup. So December then becomes a dead zone for new deals. So you can be going into December with maybe talking to some investors, but really it gets wrapped up pretty quickly, because that December 15th mark comes in, and then it's hard to get a check written. Only if they're co-investing and they're like, oh, you need to get on this round, come on in. That might happen in December, but that's probably the only thing that's happening in December. So smart founders recognize the pattern and act accordingly. So the power of relationships, I've already kind of alluded to that. It is not a sprint, it is a marathon. So it's about trust building. I always say it's TRUST is tremendous reciprocity between you and us, with sincerity and transparency. So that transparency, that reciprocity of letting them know what you're doing, them saying, I do have that thesis and you align to my thesis, I can invest in you, let me ask you some more information. That founder brings back information. That reciprocity going back and forth is super important. Investors ultimately back you and your business, but it kind of shifts a little bit, right? And everybody knows this, but I think that it's always worth talking about. And I'll tell you what is traditionally what it is, but it's shifting a little bit now in 2025. So we have pre-seed, seed, and Series A. Everybody knows that, right? So pre-seed, it's more you and the business. So like capital U, lowercase business. They're betting on you as the jockey versus the horse. Investors are going to be investing more in the jockey. Then in seed stage, it's you and the business. Like you're really pushing through, you're being dedicated, you're passionate, and there's some business traction, or there's some development of that technology that allows them to say, hey, actually that's working. There might be some revenue coming in or not, depending on the industry. And they're really going after the horse and the jockey. Then Series A is more of the team, but not just you, but you and your team. You have attracted the right team. You've attracted the right investors to come alongside you as this not just solo jockey, but they're going ahead with you, and they're allowing you as a jockey to be even more successful, like making sure that you look great, make sure that you're do all the things to get you ready for being that jockey as the CEO. And the business is equally as important, right? So recurring revenue, scalability, and sustainability. Now, I'm hearing on the ground, and I know as myself as an investor, investors want revenue even in seed stage. And so I have heard that investors want revenue in pre-seed. So all of that is coming down the pipeline. Before seed, I would say 50-50 that you needed revenue or not, depending on the industry. But I'm seeing more and more investors wanting revenue in seed stage. So for those out there that are like, are you kidding me? Like, how do I get revenue? Right? If you are estimating and having your financial projections going out 2 years from now, I'm going to get revenue because of XYZ, change your mindset to say, how do I get early revenue? It might be a little bit different than what you thought about, but ask your team, ask your advisors, what would be the strategy to get that early revenue in 6 months to a year? And it might shift a little bit, but you're really thinking about your go-to-market strategy, right? It might be a pilot that you might be able to get that is a paid pilot instead of a pilot that is not paid, and then you're going to do 2 years of that and then go forward. It's like, ask that partner that you have, can we do a paid pilot? Even if it's a small amount or a fraction of what you would get overall, if you definitely had revenue from that partner or from that customer. Another company of mine went from a medical device to a consumer device, right? Because investors wanted to see revenue. So she did a website that said, you could buy her medical device earlier. Of course, it had to be all approved and all that, but you could buy it earlier, and that was pre-sales, right, on a website. Very interesting. She would have never thought she was doing that, but she did do that. And the investors love to get the product, test the product, and then actually reinvest in her company, as opposed to waiting for the product to come in 2 years later, because that is a medical device. So just think about, be creative with how do I marry that together as the current situation right now. And then Series A is asking even more revenue, a lot more data, a lot more things that you need to get done. And those are more institutional investors, but a lot of the institutional investors are coming down to seed and pre-seed. So know that it's a little bit of a shift right now. Ask them the questions of, what are you looking for? What is the traction that you need? Okay. I'm going to go forwards to, let's see, I'm like, everything's in its way right now. So one of the things that I like to say for right now at the end of year, you want to go narrow and go deep, right? So you might have had a spray and pray strategy Q1, Q2, you're getting more strategic Q3. And really you want to align strategically with the sector, specific angels, syndicates, and VCs who really understand your market intimately. At this stage, they're not looking for their broad range of companies that might fit their thesis, or they're kind of in the fringes. They're looking at end of year, do they truly align to our thesis? If they're VCs, they want to make sure that aligns to their thesis, that they're telling their LPs that they're looking for. For angels, they're like, okay, if it's not in my wheelhouse, they're out. I just want to be really focused on who is right aligned to my thesis. So for the entrepreneurs there, how do you respond? You respond accordingly. You say, I'm going to also focus in Q4. So I said 5 proven ways to find angel, because this is the question that everybody asks me. Yeah, great, Sylvia, go narrow, go deep. Well, where am I going to find those investors? And this is something that you probably already know because you've already been in front of investors Q1, Q2, Q3. But on LinkedIn, you can do a lot of LinkedIn intelligence. You can search for the panels that they on, articles that they've posted, sector thought leaders. They're talking about the sector. Let's say it's a medical technology or a health tech thing. They're talking about it. They're sharing articles. Get involved with that and interact with them and know who are the thought leaders. Number 2 is investor profile analysis. So some profiles that you can get that have that openness of the conversations, they might be able to be, you might send them a DM, don't pitch to them, just say, hey, I saw you on this panel, or you know what, I saw you at this event, or great article that you shared. Can I ask you some more clarifying questions? Have you considered this? Instead of just pitching to them. Whenever I see a pitch on my LinkedIn, I get like 500 plus messages probably every 2 or 3 days. And if it's a pitch, I delete until somebody's like, hey, I saw you here. I'm like, oh, they've done their homework. They paused a little bit. Oh, it's personalized. Let's do that. Number 3 is AngelList Crunchbase mining. So you can do some, you can conduct some deep portfolio analysis to identify investors with relevant sector experience. So how you can do that is that in AngelList and Crunchbase, you might find companies that are a little bit further along. They might be in Series A. Who were their investors, right? See who were they and see like, oh, I realize that some of these are the ones that are on my list. Interesting. I should probably reach out to them. So do that connectivity of the dots of what you learn on AngelList and Crunchbase of who they have invested in, who are they co-investing in, who are they syndicated with, because there's syndicates on AngelList, and does that align to what I'm looking for of investors that fit my company, and I would love for them to be on my cap table. That again, personalization, connectivity of all the dots is what your job needs to be in Q4. Be focused, be narrowed. Number 4 is ecosystem intelligence. So leverage advocates and connectors who are in your ecosystem right now. Let me tell you, we have every single tech week coming up. We have San Diego Startup Week, we have LA Tech Week, we have New York, Twin Cities, Chicago Tech Week. There's so many tech weeks going on. It's like the perfect time to find out who are the connectors in the ecosystem, who are doing events in our ecosystem that are the connectors, and ask them, hey, who are the investors that actually are open for conversations? Who do you think could be a great coffee meeting person? We just finished our Women's Venture Summit for Stella Foundation, and we were able to connect really great angels with founders because we know who they are as purveyors of that event. Lastly is syndicate mapping. So research the syndicate lists to discover who co-invests together in your space. You can find that on AngelList. There are some syndicates like the Angel Syndication Network, ASN, does post who are the investors that go into that syndicate. Sometimes they also post the success stories of, hey, we invested in a SaaS marketplace. Oh, interesting, they did that? Oh, I need to go to that syndicate and see how do I get involved. Again, connect the dots very, very mindfully. Next up is creating your investor persona. Now, I'm gonna right after this, I'm gonna give you a template of what that looks like, but who is the right investor for you? So looking at your cap table, see who is on your cap table. That's a capitalization table. So if you have some investors, they have certain percentage of your company, and say, you know what, who are the ones that I really want on my cap table? Because really you want to think beyond any check is good, right? You want to have that alignment with that investor, especially in Q4. You want that person to come in. You're thinking about check size. You're going to think about geography. You're thinking about sector experience and syndication, right? Those are all forces. Remember, we were talking about the 3 C's of capital at the very beginning. So the check is just the check, right? But that resource and network capital allows you to understand this investor who's going to come in. I want that persona. And what's interesting, when you get that persona really down packed, there's 2 things that happen. One is that whenever you're talking with your team members or other advisors, you're like, oh yeah, I have a persona. Her name is Maria. And what she likes to do is she likes to invest in this industry. She writes these types of checks. And if we get an average of $25,000 from her, right, then we can maybe ask her if she could introduce me to other people just like her, because we really like how she is. And the second thing that happens is that when you have that sense of like ownership of what that person looks like, it's easier for you to say in your ecosystem when you're going to all of these events, hey, I'm looking for this investor that does this, this, and this. Do you know anybody that could possibly be in that category? Then people think, oh yeah, I know somebody of this, and I know somebody here. They're not thinking, oh, I'm not going to introduce you to anybody because I just can't, or it's too much. You're being more open in that conversation, saying, who do you know that might fit this persona? So it's just a different view. If anybody's done like a customer persona, you know that you get to that customer persona by asking lots of open-ended questions. And then you ask, oh, do you know a customer in this? Or do you know a customer here? You know a customer who's looking for this? They behave in this way. All of those things is exactly the same. And I'm going to give you oh, I don't have that. I knew that I had, wait, let me make sure it's back here. It's down here. Sorry. The template for the investor persona. I know that I did it. I don't know where it is. Wait. It is. Investor persona. I knew that I had it. Sorry about that going back and forth. But this is a investor persona template. If you've seen a customer persona, it's the same thing. You want a picture on the right-hand side of who that investor is, so it becomes more human. That person becomes more human. Then, you can name the investor or investment group. You can talk about the check size, portfolio size, and examples if you found that. And the stage, are they pre-seed, seed investors? Then you're going to go down on the left-hand side. You're going to think about relative behaviors, their needs and goals, relative motivations, demographics and psychographics, industries, and then like other notes and values, right? So let's go to relevant behaviors. I've covered this before, so that's why I'm going a little bit fast. So relevant behaviors is that, are they exploring the investment landscape? Do they donate to NGOs? Are they socially conscious? Do they prefer to make their own investment decisions? Are they impact investors? Do they care about going to events? Do they care about networks and building the startup ecosystem? What are those relative behaviors? Do they go out to coffee a lot? Needs and goals is diversify their portfolio. They want to increase their wealth. They want to empower founders. They want to promote growth in their ecosystem. All of those things are the needs and goals that that investor would have. Now, this is a hypothetical investor, right? You're like, how do I find that out? No, I'm asking you as founders, what would you like to see on your cap table? Who do you want to influence the launch and scale of your startup that you are doing so passionately? You want these people to be part of your bigger, group of people that are advising and supporting you, right? And you want to put that out there. So number 3 is relative motivations. What is their incentive to invest? Maybe they have achievement. Maybe you want them to be a CEO of a multi-billion-dollar company because you want them to like really breathe into your business model. And lastly is power. Like what brings them power? What motivates them? So demographics and psychographics is very like 101 is that demographics is like how old are they? Where do they live? And psychographics is how do they behave, where they are, what are their likes and dislikes. And then industries, obviously, you're going to put your industry in there. Only if you don't care about somebody who's in your industry investing in you. That could be a possibility. And then values is super important on the far right, right? Is that what are the values that you want them to come in to your company with? Okay. So let me go back to where I was. Okay, I think we're here. Yeah, the investor persona. So tools and tactics for research, right? I kind of went through this a little bit already, but LinkedIn strategy, you can actually reverse engineer warm introductions by mapping mutual connections to identify the pathway opportunities through your network. So if you say, okay, my warm introduction, I want it to come from an investor who's in this industry, then you can go back and say, what's that industry? Who is talking about that on LinkedIn? The data mining is that, again, the Angel List and Crunchbase. The content following is track their investment thesis, sometimes is Twitter and X. And Substack has become more of a platform for people to talk about what they are researching, what they like to talk about, what they want to go into. And then portfolio intelligence. Ask the portfolio company founders, if you can, the critical question, would they invest in you again, right? This reveals true investor value add. So if you do find the portfolio, you ask the founder that is already in their portfolio, do you think that they would invest in you again? And why do you think that maybe they could be interested in me, right? Do that intelligence. A lot of founders want to help another founder, right? Maybe they're farther along than you. They want the whole ecosystem to thrive, right? So if the ecosystem thrives, they get more investors who invest in them and you. So it's mutually beneficial. Okay, so crafting your outreach. I get asked this a lot, so that's why I want to go into this. Is personalization beats spray and pray every single time. Your outreach must demonstrate that you've done your homework and understand why this specific investor is the right fit for your company, right? So I get a lot of, I want to pitch to you because of this, and this is my company. I am amazing, and please invest in me. I'm like, I'm never going to respond to that. But a perfect email structure based on like what I love to receive, and also I've done so many warm introductions that this is what I like for the investors that I connect with, get that email from me to be able to put that entrepreneur in the best light possible. Okay. So this is just something that I've been successful at. So the perfect email structure is a, introduction and why them, open with a specific reason why you're reaching out to them personally. Like, I met you at an event, or I see that your portfolio is in the femtech space and I've been doing this for a while. I saw you at LA Tech Week. Love the panel you were on. We connected, afterwards, very briefly of this. Be very specific. And when you send this email, and if you are connected to LinkedIn, I would send a little note also on LinkedIn saying, I met you here, right? Because I go back, I don't remember everybody that I meet. I wish I did, but my brain doesn't work as much as before. And I like to go in there, and there's always like a little note saying, I met you here. I'm like, yes, I remember that person. I did meet them there, stuff like that. So number 2 is traction and stage. Quickly establish that credibility with key metrics and current fundraising stage. So it's great that you're like, I am blah, 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 blah. The problem is this. They're like, yeah, traction, revenue, where are you at? So you want to check the boxes, traction, meaning, again, revenue, traction, meaning like media coverage, traction that you have won this pitch competition, knowing that that investor cares about that. That's why that persona is super important. If you know the persona, they fit the persona, then you know exactly what traction you need to send to them, because you're like, that's what really triggers them to say yes. Then the blurb is the short, punchy sentence or two that quickly conveys who you are, what you're building, and why this investor should care. Now, the blurb is something that you can also like copy and paste everywhere, but in all of the emails. And that's something that you can send to advisors or mentors that are doing warm introductions to you, for you, right? You send them, they are going to ask you for the blurb, and this is what that is. Then there's a personal connection piece. Again, you can do the in the introduction. I just wanted to say that show something that you've done your homework, not just in the introduction, but somewhere else. Connect your startup directly to investors' thesis or portfolio or something like that. Then number 5 is a clear call to action. Request a specific next step with a defined timeline. Hey, can we get on a call in the next 2 weeks? Or I'm going to be at this event. Are you there too? We would love to meet up. Something like that, just something that's a clear call to action. Why? Is because investors really love whenever they get updates from startups, like your quarterly or your monthly investor updates, is we always just go down to the ask, right? Where's your ask? What's the call to action? What's your ask? And we will always skim an email to find that. If we can help you, great. If we can connect with you, great. We're always looking for that. So it just kind of, we're already trained by it. Use the training, right? Use how we're trained. Number 6 is closing with gratitude and with a sincere thank you and a clear note of flexibility. You're willing to work around their schedule. When can they meet? But again, that gratitude is going to go a long, long way. And then a pro tip down here, I just said, connect your pitch directly to their published investment thesis. Try to connect those dots is so important. I wanted to pause another time to talk to you about the investment thesis. Some of you don't know what that is, right? So I want to make sure that we're clear, that everybody knows what that is. So this is like a template that I teach investors of how to build their investor thesis. I tell them as investors, if you create this investment thesis, you can repeat it to entrepreneurs that are asking for funding, and you can also tell other investors, this is what I invest in, so that they can send them the right entrepreneurs to increase their portfolio. It's like a win-win across the board. So the template is, I invest, then typical check size or percent total investment portfolio at the stage of company, stage in maybe a geography or not, to fund startups in a sector or market companies with some kind of secret sauce, right? You can add something like, I provide assets you can bring to the company. That goes back to the 3 C's to my portfolio companies, because I have a background in blah, like that goes back to the resource capital. I like to, how do you interact with companies or founders? I prefer not prefer a board seat, and request typically asks of founders like information rights, right? I look for liquidity in less than some kind of period. My overall angel portfolio return goal is multiple of investment, 3 to 5x or something like that. So that multiple usually applies to VCs, but some investors have that. And I'm going to give you an example. This is my investor thesis. As me, Sylvia Ma, right? I'm involved with a lot of angel groups like Stella Angels. I'm involved with Next Wave Impact. We were a fund. We are not allocating any more funds, but we had a thesis. Then San Diego Angel Conference has a thesis in and of itself, with all of us like kind of applying into that thesis. But this is my investor thesis myself. So I invest in women-led or minority-led startups in the seed round. I don't typically do pre-seed, typically 5,000 to 25,000 each deal. I'm industry agnostic, but prefer deep tech enabled solutions because I have my PhD in biochemistry. I love deep tech. I focus on looking for difficult problems that I believe can be solved with the right team. I can either lead around if it is in my wheelhouse of expertise or follow on. I like to take an active role in advising of the founder. I know that it kind of wanes off after a while. That's fine with me. I prefer a board seat, but not necessarily. And request information rights. I want to know what's going on. I look for liquidity event in 3 to 5 years and 7 to 5 years for life science. So that's very clear. Everyone knows exactly what I invest in. And I ask information rights because I like to be informed, and it really is just adding my name to the outreach of the founder as they're moving forwards in scaling their company. So it's not too much of a burden of the founder. I don't want to be a burden. I want to be an accelerator of that founder. I want to be a catalyst for that startup, and I want our company, right? Because I'm going to own a little bit of it, to flourish. And I want that founder to flourish as well. So all of that is meant to do this. Somebody asked me on Tuesday, I was speaking at UC San Diego, and somebody asked me, it's like, what does it mean to be founder friendly? So this is a very founder friendly investment thesis, right? That I want to really actively have a role in advising the founder because I can bring that expertise. That's the 3 C's, right? The experiential capital. I prefer a board seat, but not necessary, because I'm not going to be like, and I want a board seat. Why? Because I don't invest that much. If I was investing 100K, 200K, like another VC, then I would want a board seat. And that's like a little bit more like I request a board seat. That might be, some people think is founder friendly or not founder friendly. So I just wanted to give you the reasons why I chose every single word on this investment thesis. Okay. So time of year, timeline to end of year. I'm just trying to check on the chat here. Where am I at? 30 minutes. Thank you. So the timeline to end of year is like a 3-step process, right? Success in Q4 fundraising requires precise timing. So September to October, you want to finalize your pitch deck. You probably already have it, but your terms, your deal room, have everything ready. Build and prioritize your investor target list. A target list is a sales list, right? You want to just sell to these investors and go top to bottom, tiered 1, 2, 3, and go for it, right? Do the sales calls, do the emails, do the pitches, go forward. You want to start warm introductions and early conversations. Again, marathon, right? Remember marathon. Refine investor persona for optimal cap table fit. So you might have a persona, but now that you're talking to people, you're like, you know what's really like how I'm selling to investors is this way. You might want to change it a little bit. And then practice and polish your founder narrative. So you as a founder should have a narrative of like, why did you start? That's more of like your um, like a brag statement. Like I started this company. I love what I do. I love my team. I have this investor. The technology is transformative. Whatever you want to do, just have a narrative. Number 2 is by November 1st, all targeted investors identified and connected. The due diligence processes are underway. And then host group update sessions or demo days and confirm key terms with lead investors and anchors. That's by November 1st, because you have a month to like close. December 1 deadline is that you want to finalize investment decisions. They want the wire transfers to be initiated, closing the documents, prepared and lined up, and then you want to deploy scarcity and urgency messaging effectively. We are going towards the December 31st close Please get your information in. If you are interested in all of that, we are going to be closing by end of year. And then if you need to, you can structure the bridge or tiered rounds if needed. Now, we went through this already. So founder year success stories. I wanted to give you a little bit of success stories and make sure that you understand that. So okay, I can answer that question in the chat afterwards. So founder year end success stories is, let's say, like there's a couple of this. I didn't put their names, but let's say a SaaS success, and this is from actual data, is they locked investor lists in early September. So like the list was ready, it was reviewed by mentors and advisors. They created a November 15 close deadline because they're like, I don't even want to go through Thanksgiving, and we can always extend our runway if and our not our runway, but extend our round if there's interested investors. Then wire transfers completed pre-Thanksgiving through focused outreach, right? Now, this health tech win was more of a pre-seed company, and she secured 3 strategic angels via targeted angel lists and LinkedIn research. So she was just going straight into like, these angels are about health tech. They are almost there, and I really want to reach out to these 3 and try to get them in. They know that this person knew that they were accepting new companies and they were writing checks at the time. So they leveraged the sector expertise for warm introductions. And the customer brand Series A hit November 30 close date through systemic investor engagement and transparent due diligence. They gave them all the information up front. This is all that we're doing. And usually that doesn't happen quite like dramatic, but they did it as dramatic as possible, and that they knew that they had a really good traction. And then a family tech dedication is that this family tech company were really aligned to the mission-driven angels. These mission-driven angels were more like, hey, I want to make a difference into families and communities, and they enforce a strict November close. Like, we are closing in November, come on in, or we're going to go forward, because they were building a little bit on revenue as well, right? So it's like a little bit of revenue, a little bit of angels. If we got more angels in, she knew that she could go faster, but she was building on revenue. So she's like, okay, I'm going to have that close. I want to like execute in November, and she secured everything before the holiday season. Okay. So one thing as a watch out is just avoid founder burnout. You hear that all the time, but how you can avoid that is, you want to focus over volume, right? Is that you want to target 15 or 20 aligned investors, not the 200 random contacts. I mean, yes, it's in a numbers game as well. You should be going out and like seeing who is possibly out there, doing all the research that you can. And you might be hitting 200 random contacts, but you really want to get targeted into those aligned investors that align to your customer persona, I mean, your investor persona, your who you want on your cap table, all the things that are part of that. Then quality relationships, build genuine connections, not transactional interactions. Transactions are just like, they're going to be say no or yes, no problem. But if they know you, if they've gotten to know your company, interacted with your other investors, you're like, I'm in, because I really have that connection to that startup, especially in the pre-seed range. Strategic patience is, remember, relationships matter over desperation. Relationships matter is greater than desperation ever will, right? You don't want to be desperate. You don't want to be like, I only have 2 more weeks of runway. No investor wants to hear that. So you want to build slowly. You want to build so that you have enough time to get in front of people. And then healthy boundaries, protect your energy by setting clear fundraising hours. No 24/7 I'm available, right? You can get back quickly and efficiently, but you want to be careful about that. Next up is just common mistakes to avoid, and then I'm going to go into some data. So casting too wide of a net, we've talked about that. The generic outreach never works. Be as personalized as possible. That December push, waiting until December guarantees investors delays. You want to do it now. You want to think about right now, let's get all that going so that by December 1st, I know who's in and out. And even if you know that nobody's in, you at least know that, and you can actually make sure that you're starting in January fresh. Some people, whenever I talk to them around December 1st and they have not raised any money, we pause fundraising and see like, how do we do this so that we can start fundraising starting January 15th? No firm deadlines. Without the urgency or clear closing dates, investors naturally defer the decisions. Let's go down the ride. And then you need to be prepared. Incomplete deal rooms, undefined term sheets. I also have stopped due diligence when I have all the everything in the deal room, but the team that's supposedly in the deal room, right? They don't have anything on LinkedIn. Like they don't have any place that they're working on this company. I'm like, what is going on? Right? I stop due diligence. Will not continue until they fix their LinkedIn. And if they don't fix their LinkedIn, they don't get the check. If they fix the LinkedIn, I'm like, wow, that's pretty cool. Like they just didn't realize that, again, founder friendly, right? And I'm like, okay, I'll give you the grace. Let's meet again. Let's see where we are. Let's reevaluate the deal room. You can, reverse engineer the warm introductions. We've talked about like that email and stuff like that, how you can reverse engineer those warm introductions. And I wanted to go through this because really cold outreach converts at a dismal 2%, but warm introductions convert at 40 to 60%. So why not reverse engineer it? So map your network, identify those first and second degree connections with mentors and advisors. Think about all that network, identify mutual connections that can have that connectivity, right? That can connect those and cultivate that introductions pathway, saying you want to build those relationships. You want to have key connectors ready to have those introductions and to provide that value first and then ask later. Now, I promise you to get at the very end the 2025 investor landscape. So it's important to understand the current market details and dynamics, right? So the market snapshot is that there is the VCs right now are still holding significant dry powder from earlier vintage funds from 2022 specifically, but deployment has been cautious. So it's not that they haven't deployed anything, but it's cautious. They are also going down from Series A down to seed to pre-seed. So according to PitchBook, most dry powder today is concentrated in funds of 2022 vintage and later, yet fundraising activities remain sluggish. They are having a really hard time raising their next round with their next fund. So some founders who talking to VCs, they have to wait for them to do fund 2, and that might be 6 months from now, right? So in the first half of 2025, approximately 27 billion was raised across 238 funds. That's dramatically down from 2022 peaks. But many funds face LP, which is limited partner pressures, to show returns before raising a new vehicle. So you're seeing that there's a push and pull for VCs, and angels are not getting enough exits, right? I haven't had an exit in 3 years. So I'm a little bit more cautious. So think about that cautious piece. They're cautious, therefore their risk tolerance is going down, right? They are looking at all the risks and they're like, oh, I'm done. There's too much risk, right? So I wanted to show you this graph right here is that the global VC funding is pretty down right here. So this is from Q2 of 2024 and Q2 of 2025. So you'll see that these two are pretty down. VC dry powder is a little bit up, right? That's 500 billion. Then VC fundraising down, but early stage deals, you see how different this is? That in 2024, there was a lot more of early stage deals than right now, Q2 of 2025. This is PitchBook and Crunchbase data. I like to show this to founders because sometimes you're in your bubble and you're overwhelmed with like, oh my gosh, it's me. It is not you, right? Yes, if you don't have the right pitch deck and all of those things, and that's what the Brink SBDC does really well, is to get you prepared with the right pitch deck, the right investor list, and make sure that you are saying the right things and you have the right value proposition. So really, I kind of go through these data here. It says the global VC funding is up year to year, but still uneven. VC dry powder remains high, right? But deployment is what? Cautious, right? VC fundraising slowed, right? Early stage deals down in count. So fewer checks are being written at pre-seed and seed. So that's like that upswing and downswing. So the capital is there, but it's selective, slower and concentrated. So this perspective of going more personalized to be really focused and grounded makes complete sense with the data that's out there of where the VCs and the investors are dealing with. Okay. So I want to position yourself, you want to position yourself for success. I want you to be encouraged, to be focused, to be ready. And the venture capital landscape of 2025 rewards founders who approach fundraising with surgical precision rather than broad-based outreach. They want you to be very, very focused. They want you to have a targeted approach, again, focus on 15 to 20. The time sensitivity right now in Q4 is that you want to execute your strategy immediately because November 30th is your hard deadline for commitments. And then relationship building is super important, right? Do not wait. Even if you're going to go 2026, January 2026, start now to kind of get those things going, because then everybody shuts down November, December, and that's okay. Let them shut down, but you're ready to hit them hard in January again. And so strategize now and execute with urgency. So this is just like part of what I wanted to kind of go through. I want you to map your targeted 20 investors. I want you to send emails that are very tactical, very clear. You want to really focus on those warm introductions, reverse engineer those warm introductions, and be as specific as possible. Do a lot of research. Don't send out the 200 emails. Do the 200 pieces of data to find those 20 investors that you're going to get in front of, and you're going to try to convince them that you align to their investment thesis. So I think that I have about 15 more minutes. Yes, I do. I'm right on track for discussion. So I know I have one question in the chat. Actually, I have two. That's great. Susan, you said that, what do you consider women-led? Do you require a certain percentage ownership? So I will tell you how I personally, as an angel investor, writing my own checks and what Stella Angels, and then I can talk about other specific groups. And this goes to any specific group that is like founder focused on women or diverse founders or something like that. So I want it to be more than 50% ownership by women. So sometimes it's a founder and the board or a co-founder or something like that. I don't mind doing that. Typically when it's something like that it's not just the co-founding team, we have a conversation about that, right? Why were you put down to like 20% ownership of a company that you're raising? That sends up a little bit of orange flag, but sometimes there's a reason for that. And then for other, like Stella Angels, we want it to be, so Stella Angels is an angel group by women investors to invest in women founders. We require that there's more than 50% ownership of women in the company, right? Other like Golden Seeds, they are a not only women investors, women and men investors that invest in predominantly women-led, like women in leadership companies, right? So it's a little bit different percentage. So ask them what they're looking for, and they should let you know what that ownership threshold is. The next question is regarding LinkedIn profile. Do you recommend having both a founder and company page for pre-seed? Great question, Natasha. So I'll break it down a couple of different ways. So the LinkedIn profile for yourself is that, and I'll stop sharing so you can see me a little bit better. Let's see, pin, there we go. Okay, yes, LinkedIn profile. So you as a founder have a personal brand, right? That you should actually be cultivating, right? That you care about these things. You are on panels. You are the thought leader in the industry. And then you have your company page. Now, a lot of pre-seed companies that don't have a website yet, right? You don't necessarily have to have a website. You can have a LinkedIn presence, right? To actually be able to showcase what you're doing and maybe post in. That's the brand of that company and what that goes forwards. A lot of my students at the university, I tell them first to just do a LinkedIn page. It takes seconds to do. And then of course with AI, you can use Gamma AI or Lovable. My high school students that go through a camp for 5 days, they have their websites done in like 2 days, right? So you can do that and thinking about branding, but think about personal brand as you as a founder is so important. And then your brand for your company, it doesn't have to be perfect, people. No perfection here, right? It's done. The investor can see that you're active because at pre-seed, a lot of investors like, are you active? Are you not? Do you have a business? Do you not? Are you a C Corp? Are you not? Are you an LLC? Are you not? Where are you in the development of your prototype? Sometimes it's very gray. So the more that you can say, this is where we are, this is what we have, this is our LinkedIn profile, that would be great. I would say my last thing about LinkedIn is that your team is super important too. So if you are putting on your pitch deck, I have a CEO, I have a CTO, and a CMO or something like that, and they do not have that on their LinkedIn, that's a little bit of an orange flag. However, I know that sometimes it's incognito, right? Like you have a CTO that's working someplace else, like they're like at Northrop Grumman or they're like at Google, but they're doing this on the side. You can put in the pitch deck incognito, right? If you want to, so that they know that they don't have to like hunt for it on LinkedIn. But if it does not say that, I want to see it on their LinkedIn. Okay. Okay. One question is, you mentioned capital is still there, but being deployed more surgically. Yes. For category creative products in underserved markets, what's the best way to show investors that now is the right time to move despite the cautious environment? Really good question. So, no matter what that value proposition that you're putting forwards as a founder and in your company will showcase that, right? That it's ready right now. The more that you can say founder market fit, right? Me as a founder, I know the market really well. Like I know the nuances, I know the ups and downs of it, and I know the time is right now. You need to listen to me, right? And then it's like, okay, and we have a product that actually solves a problem in this industry, and we have some traction that allows me to say, yes, we see a little bit of a traction that's again pre-seed, right? It's a little bit early, but you're kind of showcasing that that's important. They are deploying more surgically, but typically what I'm seeing is they're deploying in the industries that they know, right? So the more that you can say, hey, investor XYZ, you are really knowledgeable in this industry. I am too. Let's connect the dots and see if this is a possibility. I'm trying to get founders away from, I'm going to send out 200 emails and somebody's going to invest in me. That just doesn't work. So the more that you can connect the dots, but again, like I'm not trying to be like happy, 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 and this is going to be great. It's more of like, it might not work, to be honest, right? It might not work. Even if you connect the dots and you're surgical and you're strategic and you're all this and all that. So that's why I say go back to like, if you can build on revenue, right? So that you can, that's just a slower growth, right? Investors putting money into your company means that you are going to grow faster. That's a beautiful thing, but it can also have some cons. So know that in this day and age, especially with the market volatility, they might not invest in you. You might not get the investor who wants to write you that check, or you might have to go to like more investors that give you smaller checks than before, right? So just, I would say that if you have this open posture of like, I understand the market, I understand where you are, let's work together. Because I know that like some investors that are not deploying capital, but they know who is, they're like, look, I can't write a check this year. I can't do it. But man, you are incredible. And what you're doing is really great. Let me try to find out somebody who could write you a check. But if you don't have that relationship build and all of that, it doesn't work. Okay. Lisa House, okay. Is there a resource we can use to help us determine the exact amount of money we should raise in pre-seed that is justifiable for investors and the buckets of money are going into the right places they would expect, i.e., for example, marketing versus employees versus operating costs. That is like that's a question of just like, how do I make it all work really well? So, Lisa, the person who asked the question is like, meeting with advisors is probably your best bet because it's so specific, right? But typically, like pre-seed in general, you're not going to find something that's like 60% sales, 20% legal, and no development, like technical development. You're not going to find that. People are like, why are you focused on sales? If you are a tech company and you don't have an app, you're going to probably take about $40,000 of whatever you're raising and put in that app development. So I would say the more important is that you connect the dots between where you are in your company, what you need in the company financially, and that pie chart of what is it that you're really going to focus in the next 12 months? Does that make sense for the industry and for the company that you're working on? Yes, you have all the right pieces here. It's G&A, marketing, employees, operating costs, and tech dev, like the technical development. So you have all the pieces of it. Does it make sense for an early stage company? And it also needs to make sense in the industry. So I would do the best case scenario. You are the founder that knows the most information, right, of your startup. So the more that you can say, my assumption is this, my assumption is this, my assumption is this, and have a conversation with an investor, that's like really, really brilliant and beautiful. Okay. So how realistic, next question is, how realistic is it that if we full force follow this wonderful plan, thank you, that funds will be distributed by end of November, assuming the business fits? Does the legal structure of the company prolong this process? So I'm assuming that the legal structure is like an LLC that needs to be converted, or that it's already a C Corp. So I cannot say that, like, I cannot confirm that you will get these, these funds in. I cannot say that because it just depends on the industry. It depends on the investor. Now, the realism of getting something by the end of November, I'm not saying that the funds will be distributed. So let me just like clarify that. I would say by end of November, you should have already had 1 or 2 conversations with investors. They should be closer to closing, right? You might be at maybe 10 investors that you're talking to by end of November, so that in November, right? In December, you are closing those wires, right? And sometimes wires take 2 weeks to do. So those are the things. It's not that the funds will be distributed, they will be distributed soon, but those are the ones that will come through. Now, if the legal structure is not clear, typically that's already taken care of in this, let's say, second or third meeting, typically, right? Are you a C Corp? Are you an LLC? And will that fit my thesis? I can tell you, like, if it doesn't fit, I'm going to tell you straight away, no, right? So it won't get to November, and it won't prolong it, but it will prolong it if you're saying, hey, I'm going to switch from LLC to C Corp when I get the money in. That might prolong it. Okay, could you, 3 more minutes, could you talk about exit? Sometimes the exit is going to take longer, or it's not what is originally envisioned. What is the correct way to pitching that original idea, and then navigating the exit discussion as reality sets in? So yes, usually in the pitch deck, you have possible exit partners, right? That you are going to be exiting into. Let's say a company, let's say you are a film company, let's say, right? You're selling the next best film, and you're going to sell to Kodak or Fuji or something like that. In your pitch deck, you're going to say, I'm going to sell to them. And there's comparables in the marketplace now, that's data that you have now, that indicate that we probably will have a 30x return. You can say that, right? And that investor has a prerogative to believe in it or not, right? So you can't say that, okay, I said it all wrong in the next year, but it's always about communication, right? So if you say at the very beginning that in your pitch deck, this is kind of where I stand, there's 2 pieces of it. Is like, do those partners make sense? Yes or no? And secondly, does the multiple make sense? Typically, due diligence reports, I've written so many due diligence reports. We do a whole market analysis. We make sure that we know that that multiple is correct, as much as we can see that it's correct. Pre-seed, it's also like, how correct can you be, right? It's a little subjective, right? So those 2 pieces, is it the correct partner, and is it the correct multiple? It could be. And then going forward, your question of the original idea of navigating that exit discussion is, you're going to be sending out comms every month or every 3 months to your investors. They will not be surprised if you're constantly connecting with them and communicating with them. So yes, the reality sits in, but they know the reality years in advance, right? So that's what I would say. Okay. Yes, whoever is, yes. Other messages out there, yes. So Thanks for joining us. We are done with time. Again, I want the overall perspective is that be as specific as possible. I know it's really hard, right? Because it's like, and it's the same thing as customers, right? You want to like, I can sell to anybody. My market size is everybody in the world. Well, what's that first like business 101 or startup 101? Narrow. You want to narrow that investor funnel, and that investor funnel becomes big at the very beginning, and then it becomes smaller and smaller and smaller and smaller and smaller. So that check size goes in. Then end of year, you're basically just chopping off the bottom of that funnel saying, how do I get to end of year? So timeliness, making sure that it's a marathon, not a sprint. You want to make sure that you have these deadlines sort of in place and know that if you are saying 2026, the next year, they will push you out. So work with FOMO, work with warm introductions to get you that personalized introduction, that personalized piece to get that solidified. So best of luck to everybody. I know it's really, 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 really hard right now, and sticking there with everybody. And don't forget that everybody on this call and whoever you have in your ecosystem, they're also your supporters, other founders, because those other founders are like, I just had an investor meeting that was horrible. Talk about it. Or, man, I had an investor meeting that was amazing. And you know what I learned? Boom, 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 boom. You're like, oh, I can do that too. So know that work together to really build the right pathway for you. And that journey is going to be just brilliant and awesome. So best of luck, everybody. Okay. Bye.